Hey everybody, this is Mark Kelly from University Financial Strategies. So I just wanted to talk about how do you draw your money out of your retirement plans. And so that's what we're going to spend a few minutes talking about, and hopefully this helps you. So tax efficient retirement distribution. So we're talking about what's the plan to draw an income once you're retired. And so there's various ways of doing it. There's various types of accounts, and so question is, what is your strategy on that? So are you going to take money out pro rata for each of the accounts, a little bit of each account, or certain accounts at a time? And so what we're going to talk about, what is the impact of doing those things, and then how does the taxes impact you in retirement? And then thinking about a more specific way to convert money to a Roth IRA with the potential of being able to pass on to your children tax-free. And so we're going to talk a little bit about that as well. So what I thought I'd do is I thought we'd talk about a case study. So this is the Brady's. It's the Brady's. You got Mike and Amanda, both married. They're age 56, 54, planning to retire at 65, salary of currently of $200,000 and $100,000 respectively. And they're planning to take Social Security at age 70. We've determined that they're going to spend about $10,000 per month. So basically that's the amount that we're going to say is replacing their income. So that will be their income when they retire, that and their Social Security. Okay. So what we have here is they have about $1.5 million in qualified money. And so when we say qualified, we're talking about tax deferred money. Okay. That may be an IRA, that may be a 401k. And then when we say non-qualified, we're saying they have $100,000, we're talking about their taxable accounts. Okay, so the question you have to be asking yourself is, okay, which accounts do I take out? Do I spend my retirement accounts first, or do I spend the tax account first? What is the time frame for doing that, and how do I do that? So in this case, what we're basically looking at is we're saying, okay, looking at the tax brackets can actually kind of be surprising. So in the case of the Brady's, we're seeing that what they have is that they're going to have higher taxable income later in their retirement. And you might be asking yourself, why is that? Well, if you look at it, so this is their income, okay? So they have this salary and income, so they worked, and then they get into the 60s, and then said, hey, they're going to retire. So all of a sudden they have this big drop in income. But then when they get to, this is saying age 70, they start taking money out of their tax deferred accounts. You're not required to take money out until age 72 now. That was a big change as of the end of last year. So you now have to start taking money out at the age of 72. That's your required minimum distribution. But what we're seeing is that when we start taking money out, coupled with Social Security, which is this in green, and then this is the required what they're taking out, or at least what they're going to be required at age 72 to take out of their retirement account, it all adds up. And so that combination then starts to be looking like a pretty big number. And so the question is, which assets should I take? Should I take my taxable one? So I should spend that down first, and then use my the pre-tax accounts, or the Roth accounts can be that's tax-free. So we want to think about the time frames of that. So what we try to do is we customize that per each client based on the income that they had, and then how much they have in their retirement accounts, and how do they fund their need? How do they pay for retirement? So it's different for everybody, but those are the factors you should be thinking about. And so again, we're talking about how large IRA distributions drive up tax brackets. And so this is just looking at it as an overlay of tax brackets. So you can see this is just using hypothetical tax brackets of 15%, 25%, and 28%. So this, the bottom line is 15, 25, and then 28. And so here's their income going into the working. All of a sudden, boom, they're actually no longer bringing in an income. And so now they need to replace their income with something to spend, right? Well, they don't have a lot of money that's going to be taxed. And so their tax bracket's going to drop. And so what we're trying to do is we're trying to say, okay, how do we leverage that to help you for the long term, or maybe we can accelerate the amount that's taken out of your pre-tax account or your IRA so that you can actually shift more of that down to these lower tax areas, okay? And so that's where we talk about a Roth conversion. And so this is important because in the last year, they made a significant change to the beneficiaries rules. So before, you could actually take out maybe your children could take the money out of any inherited IRA that they receive over their lifetime, and it may be 30, 40 years, or they're spreading that payment out, or they're paying that distribution. Well, as of 2000, at the end of 2019, they're now saying you have 10 years for the children of your that are inheriting your retirement accounts. They have to take the money out within 10 years. And so if you imagine, maybe your children they're still working, so they have their income. Now all of a sudden they have to take out a larger sum that they're going to have to pay to Uncle Sam. Well, that causes a problem. So what we did in this case, we're showing that, okay, well, maybe we take out some, in those low income years, we convert some money from pre-tax, so your IRA or 401k, to a Roth IRA, take advantage of that lower tax bracket, and we can decide, okay, do we want to just fill up the bucket to the 15% tax bracket, or maybe go higher, depending on the numbers or your comfort level, and then we can figure out, okay, what's the end proposition, down the road. So we can say, in this case, we're showing the proposed strategy saved, over $1.1 million more for this for the Brady's. And so that's an important thing. So it's important to talk about what is the right strategy to draw an income, and also what is the right strategy, depending on your situation, to actually, does it make sense to leverage your tax bracket, okay? And so, we'd be happy to run this illustration for you. You can give us a call at 919-391-7526, or you can actually schedule an appointment right on our website. Just click the top, and it says if you're able to book a meeting, and we can meet with you either in person, or we can actually do via Zoom and do a virtual meeting with you. Hope that helps you.